The S&P 500 closed virtually flat today, up a microscopic 0.02% to settle at 7,413.18. The Dow Jones Industrial Average jumped 260 points, which is a 0.51% add, while the Nasdaq stumbled, closing down 0.2%.
Right, and it's been exactly 15 minutes since the closing bell rang, and if you just look at that top-line scoreboard, I mean, you'd think it was just a quiet summer session.
Yeah, a total non-event on paper.
Exactly. But if you actually dig into the closing print, that surface-level tranquility is a complete lie. The tape today was a textbook choppy mess.
Right, because underneath that flat line, institutional traders were violently ripping billions of dollars out of momentum names.
Yeah, reallocating risk in real time. And the catalyst, the narrative driving this, was a massive, sudden geopolitical pivot.
The U.S. and Iran pausing military strikes.
Exactly. That explicit pause in strikes forced desk traders to ruthlessly reevaluate everything right in the middle of the session.
Yeah.
I mean, you saw the war premium on crude oil just instantly dissolve.
Yeah, the repricing there was violent. Brent crude plunged 6.3% down to $85.87 a barrel.
Which is a massive move for one session.
Huge.
Yeah.
And WTI crude fell 5.71%, pulling back right toward that $84 handle. But here's the thing, looking at the internals, the tape doesn't reflect a uniform reaction to that relief.
No, it definitely doesn't.
Right, because with oil dropping 6%, you would typically expect consumer discretionary and cyclicals to just catch a massive immediate bid. Lower fuel costs mean immediate margin relief.
Absolutely.
But the volume confirmation just wasn't there. Volume across the primary exchanges was noticeably below the 30-day average. So, why weren't institutions aggressively bidding up the broader market?
Well, the lack of volume confirmation tells you that the real money wasn't interested in buying the relief rally. They were entirely focused on stripping out risks.
Just structurally de-risking into the close.
Right, because the stock market isn't a monolith. An overnight collapse in oil, yeah, it helps airlines, but it creates a brutal drag on the energy sector, which, obviously holds significant weight in the broader indices.
Yeah, those exploration and production companies take an immediate hit to their near-term revenue projections.
Exactly. Algorithmic and discretionary selling kicks in, and that acts as a lead weight on the S&P 500. But on the flip side, that drop in oil triggered an immediate repricing in fixed income.
Because it alleviates headline inflation pressures.
Right. It allows Treasury yields to cool off intraday, and those falling yields provided a mechanical tailwind for rate-sensitive value stocks.
Which perfectly explains that massive divergence we saw between the Dow and the Nasdaq today. The capital didn't leave the market at all.
No, it just rotated.
Right, it rotated. The Russell 2000, which we know is hypersensitive to interest rates, that rose 0.61%.
Yeah, catching a nice bid.
But the Nasdaq took on water. It was an absolute bloodbath in semiconductors today.
Oh, totally.
Nvidia dropped roughly 5%. AMD fell over 5.4%. And Micron dropped 4%.
Yeah, that's institutions aggressively liquidating high beta tech exposure and crowding into defensive quality. But look, we have to be clear here. This is rotation, not capitulation.
Right, because true capitulation requires a huge surge in overall market volume, which we didn't get.
Exactly. You'd see a mass exodus into cash equivalents, and we just did not see that. Instead, that capital fled the overextended semiconductor names and sought shelter in fortress balance sheets.
Microsoft absorbed a ton of that liquidity, right? Closing up 3.0%.
Yeah, and SAP jumped 7.4%. Even the defense contractor RTX Corp rose 2.6%. They acted as structural sponges today.
Absorbing the liquidity, fleeing the chips, and essentially keeping the S&P 500 pinned near the flat line.
Exactly.
Okay, but this brings up a major question. You have macro risk fading, oil dropping, yields cooling, and the S&P 500 hits an intraday high near 7,480 in the morning session.
Right, a solid morning spike.
But then it bleeds out nearly 70 points to close flat. If the underlying conditions were that positive, why did desk traders actively fade the rally and dump stocks right into the close?
Because that intraday fade is entirely symptomatic of the catalyst stack we have coming up. Institutions were taking immediate profits because holding unhedged directional risk overnight right now it's just incredibly dangerous.
Because of the Fed.
Right. We have the Wednesday Federal Reserve FOMC rate decision, and if that wasn't enough, 4 of the Magnificent 7 are reporting earnings this week.
Microsoft, Meta, Apple, and Amazon.
Yeah. That volume deficit you mentioned, that is the classic hallmark of a wait-and-see tape. No PM wants to deploy fresh capital into a 70-point rally when a multi-trillion-dollar gauntlet of earnings is literally days away.
Which brings us to the volatility metric. The VIX was crushed by 4.63% today, settling at 17.72.
Which looks great on paper.
Right, on paper, a dropping VIX implies fear is leaving the market. But a 17.72 handle is still remarkably elevated for late July.
Very elevated.
It tells you that while the geopolitical tail risk was priced out, the options market is heavily skewed to protect against a domestic shock from this earnings slate.
Yeah, and the real risk here is the psychological shift around these mega cap earnings. For quarters, the market mandate was basically AI at any price.
But buy the chips.
Right. But recent earnings from secondary tech players have triggered what desks are now calling CapEx anxiety.
CapEx anxiety. Yeah, that phrase is everywhere in the briefings today.
Because companies are deploying billions into AI infrastructure, but the tangible return on that invested capital is still completely opaque.
Institutions are demanding balance sheet accountability now.
Exactly. They want to see the math on how massive capital expenditure actually translates into margin expansion.
And that CapEx anxiety completely explains the violent sell-off in semis today. The market is just pulling forward the risk.
Preemptive liquidation.
Right. Before Microsoft, Meta, Apple, and Amazon reveal exactly how much they are spending on AI, and if their guidance actually justifies that spend traders are de-risking their exposure to hardware suppliers.
Right, so Nvidia, AMD, and Micron get taken to the woodshed not because their businesses are failing, but because they are the highest beta proxies for the whole AI spending cycle.
So if you're a PM sitting on massive unrealized gains in Nvidia, you aren't waiting for Amazon's CapEx guidance on Thursday.
No, you lock in those profits on Monday. And that dynamic creates heavy structural friction overhead, which leads us directly into the options market mechanics that are dictating the cash market right now.
Yeah, and for you actively trading this tape, this is where the mechanics get critical. The briefings highlight a massive structural barrier in the options market for tomorrow's session.
The gamma wall.
Exactly. A primary gamma wall at the 7,400 level on the S&P 500 with upside resistance capped at 7,450.
Right.
It's like bumper bowling. As long as the S&P 500 oscillates between 7,400 and 7,450, options market makers are operating in a state of positive gamma.
And in a positive gamma regime, dealer positioning structurally suppresses volatility.
Right. They hedge against the moves.
Right. When the market dips towards 7,400, market makers are mathematically incentivized to buy equities to hedge their options books. When it rallies towards 7,450, they are forced to sell.
So that dynamic hedging creates the bumpers, essentially pinning the price action into a tightly compressed channel,
Limiting any breakout momentum. But the real danger is what happens if that 7,400 structural floor breaks.
If the S&P slices through 7,400, those bumpers instantly vanish. The options dealers flip into negative gamma.
And that's when things get ugly. Instead of buying the dip, their hedging requirements invert. As the market falls, they are forced to aggressively sell futures and equities into the weakness just to remain delta neutral.
Which inherently accelerates the downward momentum right toward the next major support zone at 7,350.
Exactly. That transition to negative gamma is where cascading sell-offs originate. The dealers literally become a mechanical source of liquidity drain.
So for trading tomorrow's open, you have to respect the boundaries of that 7,400 to 7,450 channel.
You do not buy breakouts into resistance.
Right. And you do not blindly hold long exposure if that 7,400 level fails to act as support. The mechanics just won't allow for a sustained rally until the major tech earnings force a repricing of the options chain.
Yeah, we are trapped in this gamma-driven channel, and the broader market is paralyzed by CapEx anxiety.
Which sets up our day two play. The institutional briefings point to a very specific asymmetric trade setup for tomorrow.
Going long on transports and airlines while shorting high beta tech.
Right, a classic pair trade. And the mechanics there are designed to isolate the fundamentals from all this macro noise.
Yeah, by going long airlines, you are isolating the pure margin expansion from that 6% collapse in crude oil.
Because jet fuel is one of their highest variable costs, and the market clearly has not fully priced in the forward earnings benefit of that overnight drop in Brent.
Exactly. And conversely, shorting high beta tech acts as your volatility edge. You're selling the names most vulnerable to negative gamma acceleration.
And vulnerable to that CapEx anxiety we talked about.
Right, effectively insulating your portfolio from the broader index fluctuations.
Which brings us back to Nvidia, obviously the primary engine of today's tech weakness. The setup for tomorrow's open centers entirely on Monday's intraday low.
That level is crucial. If early volume confirms a breakdown below that low, the dynamic hedging we just discussed will trigger aggressive dealer selling.
Flushing the stock down to its next moving average support.
Yeah. But if institutional buyers step in at the open and defend Monday's low, if we get a key reversal there, the lack of immediate downside continuation traps late short sellers.
And that sets the stage for a vicious mean reversion trade.
A short squeeze bounce where the stock violently snaps back toward its volume-weighted average price as that negative gamma pressure dissipates.
It's a pure pivot point. You have to let the opening drive volume dictate the direction rather than guessing the outcome. But, and this is the wild card, the most glaring piece of data on our desk today actually came after the closing bell.
Yeah, the Applied Digital print.
Right. Applied Digital Core, ticker APLD, reported their Q4 earnings, and the numbers are a massive disruption to this entire CapEx anxiety narrative.
Oh, they completely blow it up.
They reported $258.7 million in revenue. That is a 407% increase year over year.
I mean, a 407% top-line expansion in a single year is a staggering metric. The institutional briefings explicitly attribute this growth to explosive demand for AI data centers.
And high-performance computing infrastructure.
Right. So the setup for tomorrow requires monitoring Applied Digital for an opening drive volume breakout. If the stock opens with relative volume heavily exceeding its 30-day average,
Which it likely will, given that print.
right, then it validates a massive day two momentum trade. Institutions that were underweight AI infrastructure will literally scramble to cover their exposure.
Which makes today's session a masterclass in why relying on the top-line S&P 500 ticker is a guaranteed way to lose your edge.
Absolutely.
If you just checked the close and saw a 0.02% gain, you missed the violent repricing of oil, the rotation into defensive quality, the structural gamma trap at 7,400, and the preemptive liquidation of semis.
Yeah, you missed the entire game. And this raises an absolute paradox that the market has to resolve tomorrow.
The structural squeeze.
Right. For 6.5 hours today, institutional traders aggressively liquidated high beta chip makers like Nvidia and AMD, citing severe CapEx anxiety. They bet billions that the AI infrastructure spend is bloated.
And then the bell rings, and Applied Digital prints a 407% revenue spike, driven entirely by that exact AI infrastructure demand.
The narrative and the data are in total opposition right now. Precisely one side of this market is heavily offsides.
Heavily offsides.
If the underlying enterprise demand for high-performance computing is truly matching Applied Digital's revenue velocity, and if the mega-cap tech companies confirm their CapEx is converting into yield.
Who gets caught in the squeeze?
Exactly. Will the institutions that hid in defensive value today find themselves forced into a frantic, high-volume snapback rally?
Desperately trying to buy back the exact AI assets they dumped at today's lows.
That is the real risk for tomorrow.
That is exactly the structural friction we are watching. So for you trading tomorrow's session, a flat market on the surface means nothing. It's a high-stakes collision of capital and data underneath. Stay focused on the volume confirmation, respect that 7,400 floor, and we will see you after tomorrow's close.